Hello, all, and welcome back. Man, do we have a lot to talk about. All right, in this show, I'm going to give you my take on the week that we just had, what happened, as well as what I believe is in store for us in the week that's to come. It's a CPI week, it's the start of another earnings season, so it should be an interesting week. And then I'll also show you my own portfolio moves that I made this past week. I did add one stock. I'll let you know which one that is and how I ended up with that stock. Now, before any of that, I'd first like to just thank everybody for checking out the channel again. Thanks a lot, Bob, retired in 2020, saw that you checked back in. Thanks, Ollie, for the sub. I got one this week. Thank you, man. I definitely just appreciate everybody for checking out the channel. All right, so we just had a pretty bad week in the market. And that was after, getting a bunch of strong employment and wage data, which is something that you wouldn't think would happen. But in this weird investing world that we're in, strong job numbers and strong wage numbers isn't necessarily good for our portfolios because that's just the way the market is working right now. It won't always work this way, but it does seem that that's the way that the market is working right now. And that's because basically people are scared that strong employment data will make it so the Fed won't cut rates as fast as expected. And, like I said, in this strange investing world, the market goes as the Fed goes. So let me go ahead and show you what I mean. Now, what we're looking at here is the federal funds interest rate, and it's for the past 25 years. It kind of just shows how the Fed just kind of controls the market or just controls the economy in general. And we can see it right here around the dot-com crash. Interest rates came way down, and that's because the Fed was trying to stimulate the economy again. And then it kind of got overstimulated, which caused the housing market, one of the things that caused the housing market to go crazy. So in an effort to to slow down the economy, they started raising rates again like crazy until it got here right around 5%, at which point we had the Great Recession and then like over 10% unemployment. So they cut rates in order to get the economy going again. And they left the rates here at about zero from about 2010, right about through December or September or so of 2018. And then what happened was in 2018, here right around December, got about 2.25, and then it was slashed again, pandemic, back to zero, economy too hot. And so they had to raise the interest rates again like crazy to cool inflation and to slow down the economy. And so when we go ahead and we look at the S&P 500, we're really kind of going to pay attention since 2010, because remember, that's when it was zero. And you can see that what that did was it started a really historic bull run. It just kept going, 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 going. We had the rate hikes here in 2018. There was a couple other things going. I think it was a government stoppage. There was a China embargo or something like that, or like a tariff or something like that. And that caused the market to come way down here. But then there was the Fed stepped in and said, all right, we'll cut interest rates, sent the market back up again. Then we had the pandemic. Then we had quantitative easing. And then we had still 0% interest rates. Things got too hot. Fed says, hey, we have to start hiking rates up again, and we're going to start tightening, which sent the market straight back down. But since about, say, September of 2022, I would say that we've been in a bit of a bull cycle again. This has been a bull run, and that's because the market doesn't believe the Fed's going to be hiking anymore. They think that hiking cycle was over. And so we're basically back to where we were, say, right around here. It's not always up. It can go way down just like here. But ultimately, the direction is up. And when you look at the S&P 500 here, if you go back out and you look at the max, you can see that we're definitely in a bull run and have been so since, about, like we said, September of 2022. We're back up. We're at near all-time highs. And so it's not unique to, say, the United States S&P. If we look at other countries, say the Nikkei, or if we also look at, say, the Brazil Stock Exchange, or if we add, say, the German DAX, or say the French CAC, what we'll notice is that all of these countries had a lot of inflation, and they had to raise up interest rates. But now they're cutting their rates, so it's not just the S&P that's at or near an all-time high. If you look at the Nikkei here, that's the orange one. You see that one's screaming higher. The purple one is the CAC. and that one's way higher. And the Brazil one, even that one's near an all-time high. The only one that's lagging a little bit seems to be Germany. It's not at an all-time high, but it's getting pretty close, and you can see that it's definitely on the way up from where it was. So this isn't just a US phenomenon. If we look at the British one, the FTSE, let's have a look at that one. We got the FTSE 100. That would be the blue one down here. So it's at an all-time high, but you can see that it lags way behind all the rest. And the reason for that is there's like no tech stocks in the FTSE 100, and it's the tech stocks that make these things go up, and they just don't have any. So, but for what it's worth, they're near an all-time high themselves, and that's because they've gone through their inflation cycle and their interest rate hikes, and now they're easing as well. So it's not just the United States doing this, it's the entire world seems to be on a bull run all at once. And on the subject of interest rate cuts, what happened yesterday was we got our December labor report. And what had happened was the non-farm payroll report came out hotter than expected. It was supposed to be at about 175,000. It came out a little bit hotter here at 216,000 and left at our unemployment rate at about 3.7%, which was unchanged. Now, what this did was, because the employment report was a little bit stronger than what was anticipated, before that report came out, the odds of us getting a rate cut in March was at 65%. But then after that report came out, the odds went down to 57%. But then this ISM Services Employment Report came out, and then the odds went for a March cut went back up to 73%. So why would this go up because of this job report? Well, this ISM Services Employment Report kind of made it look like the original jobs report somehow isn't all that, that it seemed like it was. Like maybe the labor market isn't quite as strong as what those numbers would lead some to believe, as it shows that the employment was plummeting according to the ISM survey. And it was plummeting to a level that we hadn't actually seen since July of 2020. And if we go here and we look at the services sector employment, which is shown here in this here chart, we can see it's down here at 43.3, which is by far the lowest on this chart. But if we back this up 10 years, we can see it's only ever been lower here at the bottom of the pandemic. And if we back it up over 25 years, we can see it's only the pandemic and during the Great Recession. So this is actually very low and kind of alarming. And for that reason, the chance of a rate cut in March actually went back up again, because the Fed's going to see this and they're going to know and that maybe things aren't always as strong as they seems like they are. So what happened this past week? And why would things fall apart so quickly if we believe, as I do, that the S&P goes up if the earnings of the companies are good, which they are, if the Fed's not raising rates, which it's not, and we actually believe there's going to be a cut, if not in March, then, shortly thereafter. So why would we have the kind of week that we just had? And I believe a lot of that is, you can kind of attribute that to the fact that the market has been so hot for the past couple of months. We had 9 weeks in a row where the S&P was up, which is the longest streak since 2004. So basically, it was just profit taking, I think, by a lot of big money. They were just taking some money, and taking it home with them. They got to keep the lights on. They got to make some money. And as for our end, it's their world. We're just kind of living in it. And, the market goes up and the market comes back down, and it went down last week. It'll be probably up here pretty soon, but last week it was down. It was kind of interesting what they were taking money out of. They were taking money out of, say, Google and Amazon, just basically your Mag 7 stocks, and they were popping it into things such as Moderna and Las Vegas Sands and Bitcoin as part of like a rotation. And, I don't get into all that rotation stuff. It's kind of hard to predict where they're going to put stuff next. I'm like, I know if I had a money manager, somebody managing my money, and they took my money out of Microsoft and threw it into Las Vegas Sands, I'd probably get a different money manager, but maybe they're managing their own or something, or maybe they're doing it with nobody noticing. But in any case, this is the sort of things they were doing last week. And so that's not really that bearish. To me, bearish would be if they were like taking that money and putting into more defensive stocks like a Microsoft or like a Google. Now, does that mean that we shouldn't be concerned at all? Well, I wouldn't go that far. I would say that that should always be concerned in that kind of pullback. Maybe there was another reason. It's easy that I could be wrong. Uh, Santa rallies don't generally just kind of end so abruptly like that. That sometimes can be an indicator that the rest of the year is not going to be particularly good. I knew it's kind of strange to kind of doom an entire year because of the first week, but there are those that believe that. So it is a cause for concern. We also had the 10-year and the 2-year kind of shot up after some of those job reports. And what that means is that with the 10-year going up, so the federal funds rate's at 5.3, and so with the 10-year coming down, what they're saying is they expect the Fed to cut the rates so many times that it's actually going to get down or around where the 2-year or the 10-year is. And so what happens with the 10-year and the 2-year going up, that's the market saying that we believe that the Fed is actually not going to cut as much as we thought. We thought it would be 6 times. Maybe it's going to be a little bit less than 6 times. So we're going to move up to the Fed and say they're going to actually cut rates a little bit less than that. Also, to me, what difference does it make if the Fed cuts in March or if the Fed cuts in May or June? For me, that's like, who cares? It's just, it's one six, one half dozen. At least it's going to happen. We know that if the Fed's not at least going to raise rates or hike rates, that the actual trajectory of the market is going to be up in the long run. And are they going to cut 6 times this year? Again, who really cares if it's 6 times this year or if it's 4 times this year and 2 times early next year? The end result is still adds up to 6. It's still going to mean that we should have a continuation of this bull market. Now, that's my 2 cents on what happened last week and the way that I think that the market is going to go. I do believe we're still going to get our rate cut here pretty soon. If not in March, then shortly thereafter in May or June. And at the end of the day, just hang on to good equities and your portfolio should go up if the earnings of the companies that you have are also going up. So that's where I stand on that. All right, enough of that. Let's go ahead and go on and look at the week that's to come, and then I'll go ahead and show you my portfolio moves right here after that. So we've got a very big week in the markets coming up. So we've got the CPI report coming out this week, and that's going to be our inflation report, and that's going to come out on 8:30 a.m. on the 11th of January. That's next Thursday morning. And what this is going to allow is it's going to tell us whether or not the Fed may or may not continue with their pivot narrative, where they're actually going to decide that maybe they can start cutting inflation interest rates because inflation is under control. And what the market is expecting, the consensus is 3.2%. Last month, it was, and this is year over year, was 3.1% year over year. Now they're expecting 3.2% year over year. That would indicate that it would be a month over month rise of 0.1. I think that's reasonable. The forecast is for 3.3%, which is a 0.2% rise month over month. That also is reasonable. I think we can get here to 3.2%. I detailed that in my video last Monday. If you want to check that out, it'll be the next one that's up here in the corner, or this one or the other, as this video ends. And you can see how we get to 0.1% month over month. Last week, it was a lot more optimistic. Like they were saying that the consensus or the forecast was for 3.0%, which meant a 0.0% increase month over month. I thought that was a little bit low, 0, but 0.1 seems reasonable, so does 0.2. So if we get more than, say, 0.1, if we don't hit this consensus right here of 3.2%, you might notice that the market is going to go down on fears that the Fed may not be cutting as soon as we think, that they, because they might feel like they don't have inflation under control. If the consensus, if the inflation rate is above, say, 3.3, 3.4, or whatever, we're going to see the market's actually going to come down because, again, people would think that the Fed might not be pivoting. Now, if we get something that's pretty much here in line, I would expect that the market's going to be pretty steady. And then the very next day, what we're going to get is JP Morgan is going to release their earnings. And this is when the earnings season starts in earnest. It usually starts with the big banks. There's going to be a couple little smaller earnings ahead of time. But the big one, generally speaking, that kicks off earnings season is JP Morgan. And they're going to report the very next day after the inflation report on the 12th of January. And so What could happen here is that we might see a lot of big earnings just like, start rolling in and kind of steady this market, even if the CPI is just a little bit hot. Because after all, I know that the market follows the Fed, but it also follows earnings. And that's kind of the way I was thinking here when I got into bonds about right here, about the beginning of August, and I was planning on getting totally into equities here on at the beginning of November. And so I actually bought NVIDIA here on October 31st, and as I was rotating out of my bond positions. But one of the things I was doing was I was actually rotating into back into stocks by selling puts right here around the beginning of earnings season, which was last earnings season was about October 12th, I believe it was, October 12th or 13th. And so I thought this was about the time to get back in the stock market and out of fixed income. But what happened, you can see here, is that even after good earnings were reported by banks, the market still came down. And then even after, I mean, a lot of these Mag 7 stocks, because after that, after the bank stocks, it was the tech stocks that were up next, and they were really hitting it out of the park. But yet the market was still going down, down, down. It wasn't really mattering. Good earnings were the market was still coming down. But and that same thing could happen now. So just because we have good inflation data and we have good earnings doesn't necessarily mean that the market's going to go up immediately. But I would say that if it's just a barrage of good earnings report after good earnings after good earnings, things will eventually start working their way back up as it did right here. So let's go ahead and have a look at my open trades this week. It looks like I have a covered call against Goldman Sachs. It has a $395 strike. It has an expiration date of January 12th. Looks like I'm up $152 on this trade. I have 156 to go. If Goldman Sachs goes over 395, that means I have to sell all of my Goldman Sachs shares for $395 a piece. Stays under $395, it means I get to keep their $308 and I get to keep all my shares of Goldman. I went in and closed out my trade. My last covered call on NVIDIA, opened up a brand new one. I got $828 for 2 contracts. They expire next Friday. It says that if NVIDIA is over $497.50 next week, that I'll go ahead and sell them to them for $497.50. And that's by next Friday. If it's below that, I get to keep my NVIDIA and I get to keep their $828. Now, what does this mean? Let's talk about break even for a second here. So this is the easier one here is Goldman. So it's a $395 is the strike price, but I collected $308 for this covered call. Well, that means that I don't actually lose money on this until it goes to $398.08, because you got to add the $308 or $3.08 per share to this contract. So let's say that on expiration, Goldman Sachs isn't necessarily at 395. Let's say it's at 396, right? It doesn't mean I lose on this trade. I have the option to go ahead and sell everything for $395 and keep their money and sell all my shares, or I can buy this contract back. Now remember, if it's at $396, it's only worth $100. So I can actually buy it back and still gain $200, $208 actually, near expiration time. So remember, I've already collected the $3.08, and so I don't necessarily need this under $395 for me to make money on this trade. It just needs to be under $398.08 for me to break even. Hopefully that makes sense. Same applies to NVIDIA here. Now let's look at the week that I had. Now what I might start doing is just kind of showing my trading portfolio and just see what my gains or losses might be here. Here is year to date. So this is just, this past week here. And it looks like I've made 1,097. I actually did better than that. There's one more trade that's not, for whatever reason, listed on this, and it's the stock that I added this week, and I did it by selling a put. And I'll show you what stock that was. So basically, this is me selling, making money on my underlying equities here on SMH, ITB, NVIDIA, and Goldman Sachs. And so it looks like this past week I made about 1,097 there. Let me look at my history here. You can see here, not listed in my weekly total, was that I actually sold a put on Amazon for $147 strike, and I got $136.34 out of that. And so what that meant is if by yesterday, if Amazon was below 147, I would agree to buy Amazon for $147, even if it's $145 and say 50 cents. And so for that, I collected $136 or $1.36 per share in premium. So what that means is that my break even on this was actually what, 145.64. And I want to say that Amazon finished off at like 145.58. So I'm not quite to even on this trade, but nevertheless, I do own Amazon. I own Amazon because I'm really interested in it because one, I love Amazon, but two, I thought it was a really good deal. Let's go ahead and have a look at Amazon real quick. So Amazon's actually 145.34. So I'm a little bit underwater on this one, probably about 20 or 30 bucks. All right, so but I'll get it back. I'll hold on to Amazon. I have faith in Amazon. And if you look at Amazon right here, it reports earnings on the 1st of February. I wanted to make sure I was in before they report earnings. I think their earnings are going to be really good. I think their advertising business is going to be out of this world. Like they're up and comers, and they're charging $3 for Amazon Prime for every time. Like if you don't want commercials, you got to pay $3. And so that's going to be a big call on there. Plus, I like their Anthropic AI. I like the fact that they're looking at their margins a little bit closer. Their CapEx is kind of like expanded out. Now they're able to hit all these deliveries in a bigger, faster hurry. I think they're more concerned with profitability than they used to be. And that's a lot of the reasons why I'm bullish on Amazon. And for that, and I think a lot of people are, so you can see their PE ratio right now is 75 with a forward PE of 54. So a lot of people are expecting that their costs are going to come down. They're going to start profiting a lot more than they used to because they have already kind of expanded. Plus, they've cut a lot of staff and they've right-sized. And so basically, a lot of people think that this company is going to grow a lot this year. And I'm in the same boat. I think they are as well. And for these reasons, I love Amazon. Now, if you go ahead and you look at Amazon here, and I know PE ratio isn't everything for a lot of stocks. However, there are a few stocks, there's only about 5 stocks or so where anybody ever mentions their PE ratios, and they would be Microsoft, Apple, maybe Amazon, Nvidia. Nobody else, it doesn't matter what their PE is. Eli Lilly, nobody cares that that's sitting at about 130 PE or whatever, and that it's essentially just Bristol Myers, Squibb, Merck, Pfizer, Amgen, AbbVie, whatever. It's just another one of them, but for whatever reason, it's the hot one today, so let it trade at 150 PE or whatever. And same with Costco. Nobody cares about the PE that, but they do care about the PE of these, and so. And that's fine. So at least you know where's a good entry point for it. But you can see here the historic price to earnings ratio of Amazon is usually a good price for it would be, right where it is really at 75. There are times when it gets way higher. There are times when it doesn't profit at all. There were times in 2015 it didn't profit. It didn't profit in 2012. And then when it did finally profit, it was sky high price to earnings ratio. But by and large, you can see that 75 is not a bad place for it to be, especially if the forward PE is going to be 55. So I kind of want it in, and I want it ahead of this earnings cycle. The next one that I really want is Microsoft, but I can't seem to get it yet because like right now, its PE is sitting at 36 with a forward PE of 32. And again, I know that PEs don't matter for most stocks, or they don't matter much, but it does matter for Microsoft. You can't turn on TVs without them talking about how expensive the Mag 7 stocks are. I mean, they're the only ones they care about. And now they used to trade for a much smaller PE. These were in the Steve Ballmer days, but after Satya Nadella took over and things started getting a little bit better and more growthier for Microsoft, their price to earnings ratio steadily would climb. So it looks like a good spot for this would be about a 31, I think would be fair. And to get the 31 PE on Microsoft, let's see where we would have to go. Let's break out the calculator. So Microsoft is sitting at 367.94. And if we divide that by its current price to earnings rate of 35.61, we can see that there are $10.33 a share. Now, if I want a 31 price to earnings multiple, and that's where I'm looking to get into, That means that I need Microsoft to get down to $320 in order for it to be a buy for me. It needs to come down about another 44 bucks. Who knows? They have an earnings day coming up. It could get there pretty quickly, but I can't really dip my toe in Microsoft until it gets right around 320 at the current earnings. Um, and again, for a lot of stocks that, it doesn't matter for a lot of stocks. Like I could pop in any number of stocks right here. Let's say a CrowdStrike, for instance. Um, their price to earnings ratio, I'm sure, is sky high compared to that of Microsoft's, and their growth isn't going to be any better than Microsoft. They don't even have a price to earnings ratio. They're not even profitable. Yeah. So like nobody talks about that. So these are these is just the kind of thing I'm talking about. The only ones where the price to earnings ratio really matter, it does matter for Microsoft. They just talk about it a lot. It matters for Apple. It matters for Amazon. It matters for Nvidia. So I'm going to wait till Microsoft gets around $320 before I dip my toes in. Now, the other thing is when to sell. Now, you might have noticed I was holding on to a couple of different ETFs. I have the SMH ETF and I have the ITB ETF. And you can use this on your own stocks if you like. But, right now with some of these things, it's all about support and resistance. And right now, this one has a resistance of about 175 with support right around 160. So this is sitting right here in the middle, 166. I would get concerned with this one here. If it breaks too much far below 160, it might be time to sell. It all depends on basically the market narrative. Do I think that the market, are we in a good market or a bad market? But if we're in a kind of a bad market and this one breaks below, say below 160, breaks below support, I might have to look at like selling this one at a loss, but I'll be selling calls on the way down. Same with ITB here. It seems to have a support right around 88, 89 bucks, something like that. Again, if it breaks too far below that, then I might have to consider selling this one as well. I think I'm pretty bullish on this one. If they're going to cut rates, I think housing is going to do well. Not necessarily this year, but maybe the end of this year and through next year. And this one's going to be priced in for 2025 pretty soon. All right, so that's how I'm going to be managing those ETFs. We're just going to see which direction they go in. Hopefully, don't break support. I'm going to continue just like selling options, and I'm still kind of bullish on this. I'm concerned, bull, but still, always got to be a little concerned. But I'm still pretty bullish on this market. I think that the market is going to have a really bumpy week this week. It's going to be pretty wild going into the inflation report, and then it's going to settle out as soon as earnings start coming in and calming the nerves of everybody. And so that's what I expect is going to happen this week, and that's how I'm playing it. All right, so if you got anything out of this video, please like, subscribe, hit that notification bell. Until then, we'll see you next time. Have a great weekend. Bye. So I have been feeling a little bit under the weather for the past few days, and well, because of that, guys, have you ever had a cold and then suddenly started to feel a little bit better when you put down a couple of my sponsors this week, which is beer? Wow, I think I'm going to wake up tomorrow with a hangover and a little bit sick too. All right, my sponsor this week is Shipyard IPA. And I do like it. It's from Maine, but I picked up at the local store out here. And I have to give this beer 4 Jumana Bersecchis out of 5. Have a great weekend, everybody.